Hey guys, Rafi here from the Endgame Investor. You can find me on Seeking Alpha under the pen name AustroLib. In my last video, I played for you a segment of an interview with James Bullard of the St. Louis Fed, who laughed about inflation being higher than he was comfortable with over the next year. So today, I wanted to go into a past Fed chair by the name of Paul Volcker. I don't want to give the wrong impression or anything. I'm not a fan of Paul Volcker, and he's not one of my idols or anything, and I don't worship the guy. But I wanted to compare his humility to the behavior of the Federal Reserve now in general. Paul Volcker was appointed chairman of the Fed in August 1979 during a serious inflationary crisis for the US dollar. And as you'll see, and I'll show you in these transcripts, Paul Volcker wasn't sure that the dollar would even survive. He was very humble, and he knew what he had to do. What he did was use interest rates to attack the money supply growth rate directly. He didn't have an interest rate target. He just kept raising them until the money supply got under control and inflation got under control. He didn't know what the neutral policy rate is, and there is no record of the word neutral policy rate ever being spoken at any of these meetings that he was chair of. So what you see here is the FOMC, Federal Open Market Committee transcript of the meeting for August 14th, 1979. That was the first meeting that Paul Volcker was the chairman. And that was back when they used the word chairman because, you know, all this sexist, woke, politically correct nonsense didn't exist back then. So you could still say chairman instead of chair. These are his introductory remarks to the Federal Open Market Committee. Here he says, and I want you to get a sense of his humility here, and he did have some. He says, when I look at the past year or two, I am impressed myself by an intangible, the degree to which inflationary psychology has really changed. It's not that we didn't have it before, but I think people are acting on that expectation of continued high inflation much more firmly than they used to. That's important to us because it does produce potentially and actually paradoxical reactions to policy. Put those two things together, and I think we are in something of a box that says that the ordinary response one expects to easing actions may not work, although there would be differences of judgment on that. They won't work if they're interpreted as inflationary, and much of the stimulus will come out in prices rather than activity. So he's saying here that if we ease anymore, that all of the effects of that easing will simply go straight into consumer prices. You can see here that he has some humility and some fear. Remember, this is 1979, about 5 months before gold went to its all-time high in one of the worst confidence crises for the dollar that ever was. He says here, and it's highlighted, nobody knows what is going to happen to the dollar, but I do think it's fair to say that the psychology is extremely tender. And he doesn't even know if the dollar will survive, and he's being honest about it. At the end of that paragraph, he says, highlighted here, the danger is, however, that once the market begins moving, it tends to move in a cumulative way and feeds back on psychology, and we will get a kind of cascading decline, which I don't think is helpful. In fact, it's decidedly unhelpful in both our inflation prospects and business prospects. Now listen to this. He says, in terms of our own policy and our approach, I do have the feeling, I don't know whether other people share it or not, that economic policy in general has a kind of crisis of credibility, and we're not entirely exempt from that. There is a similar question or a feeling of uncertainty about our own credentials, meaning he's saying people aren't taking us seriously. So when I think of strategy, I do believe that we have to give some attention to whether we have the capability within the narrow limits, perhaps, in which we can operate, of turning expectations and sentiment. I'm thinking particularly on the inflationary side. Can we restore the feeling that inflation will decline over a period of time, that that's a prime objective of ours? Now listen to this paragraph. Volcker says, so I think we can't ignore the psychological problem that we have at the moment. I don't know what the chances are of changing these perceptions in a limited period of time. But as I look at it, I don't know that we have any alternative other than to try. So what you have here is Volcker, who is basically in a desperate situation, and he knows that the dollar itself may not survive. This is August 1979. Gold is about to go to $872 on January 21st, 1980, and silver is about to go to $50, meaning confidence in the dollar is about to be almost completely lost. And it's his job to stand in the breach, and he knows it. Imagine if that was the feeling of the Federal Reserve now, and imagine what would happen if the Fed suddenly realized that it had to rein in price inflation, or the future of the dollar itself was at risk, as Volcker explicitly felt in 1979. That would create the mother of all financial crises. That would be much worse than anything the world has ever experienced. And that's coming whether the Fed likes it or not. Now, there's one more snippet from Volcker's remarks that I want to share with you. And this is from the FOMC meeting of February 5th, 1980, about 2 weeks after gold peaked out. By this time, the Fed already was starting to get control over the dollar situation, though it didn't know it yet. Here's what he says. Chairman Volcker calls on a guy named Mr. Wynn, who is feeling very nervous and lacking confidence. He says, well, I have the feeling that the honeymoon of our experiment is about over. Listen to what Volcker asks him when he finishes his remarks. Chairman Volcker, why do you think we are running out of honeymoon time? Or however you expressed it, Willis. Mr. Wynn. And here he uses Volcker's first name in sort of a plea, and this is a very emotional sentence. Mr. Wynn, Paul, I hear more doubts being raised in more areas than I ever thought possible. Their suspicion is that we are not on a money target, but very much a funds target. So this remark by Mr. Wynn, whoever he is, tells you two things. First of all, the Fed under Volcker was under a money target. Interest rates were the tool. Money was the target. They were trying to get the money supply under control. Second, by this time in February 1980, they don't know if gold's going to hit another record high above 872, and they don't know if silver's going to hit another high above 50. And if you were a follower of Ron Paul, you may recall that he tells this story about meeting with Volcker, where he asks Volcker what the price of gold is. And before Volcker goes over to meet Ron Paul, Ron Paul sees Volcker consulting with his staff and asking, hey, what's the price of gold? Because he knew he had to have that information in order to tell Ron, which means he took it seriously. Thank you for watching. This is Rafi from the Endgame Investor. Please click on the link in the description below if you want to try out a 2-week free trial of my service where I guide subscribers in the gold and silver markets. I believe we are at a major turning point right now where we could see gold going to new highs in dollar terms by the end of the year.